Hi everyone, today I'm talking about 7 UK stocks to buy. These stocks are available on the London Stock Exchange and there's been so much demand, I think it's because of me being a British stock market YouTuber, for me to cover some stocks that are on the London Stock Exchange. So here I am doing it today for you guys. I do read the comments, as you can see, and I've picked 7 of my favourite companies that are on the UK Stock Exchange right now, and I'm going to set a target for you guys. If you guys get 50 likes on this video, I will make it a monthly series where I talk about some amount of UK or London Stock Exchange's stocks. And if the video actually gets 70 likes, what I'll do is I'll actually buy these 7 stocks, and not too much money, but just a little bit of fun, and I'll put them into a portfolio on free trade or something like that, and you guys can track how they do and maybe add a few stocks in and sell a few of them when they do quite well. So if it does get 70 likes, guys, I will do that on free trade. So there's a little bit of a challenge for you guys there if you want me to carry on talking about some UK stocks. Now, I don't normally talk about UK stocks and I don't really buy UK stocks. I always buy US stocks, and for you guys that don't know, there is a video somewhere on my channel that goes into it in depth about why I do prefer US stocks over UK stocks. Just to summarise, it's basically to do with the amount of returns you can get, and it's historically been a lot better that you invest in the US stock market and you get better returns off it, and that's what I do. But for sure, there is some very cheap UK stocks out there that are fantastic out there right now, so I can understand a few of you guys buying some of them stocks, and I'm going to talk about 7 of my favourites right now that are available to go buy. So number 1 is Aviva, ticker symbol AV. And Aviva do car, home, travel, life and health insurance, and it is the UK's biggest insurance firm. So insurance wise, I just see this kind of a steady little income that insurance is always going to be needed to be there, and sure, they might get hit by the coronavirus because of some of the claims shortly, but long term insurance policies will carry on rising, and Aviva are in a good place to capitalise on that. It's currently trading at £2.32, which gives it a 76% upside according to Simply Wall Street, and EPS and revenue isn't a great growth thing in this company. I'm talking about this company from a dividend point of view on this one, and the EPS and revenue are pretty much flat, but they're not looking to decrease. Debt wise, the debt isn't too bad. It's been coming down. It's got 19 billion in cash, it's got 9 billion in debt, so it's a pretty healthy balance sheet going on there. And like I said, this is a dividend stock, so when we look at this company, it's paying a dividend of 13% with a 48% payout ratio, which means that going forward it looks like it's quite a strong dividend that it can carry on playing with that balance sheet and with that quite low payout rate. Below 60% on a dividend stock is a really healthy payout rate. So Aviva really is a strong insurance play that, like I say, I believe it will carry on being able to pay that dividend, and I'm recommending Aviva from my point of view because I try to do a diverse portfolio that has some growth and some dividends, and Aviva for me is a strong dividend play that I see it carry on paying a very healthy dividend yield going forward. So number 1 is Aviva. Number 2 is Barclays, which is the ticker symbol BARC, and Barclays is a bank and one of the most well-known banks in the UK. I could have potentially put Lloyds in here, but I've gone with Barclays overall. It's traded at 89 pence, which kind of says on Simply Wall Street it is at 71% undervalued right now at these prices. It's got a decent revenue growth, a good EPS growth. Banks wise, with it being Barclays, I see them just steadily growing the revenue and EPS, bit like Aviva really, a bit of a safe company. It's got an okay balance sheet, its cash is covering its debt, and once again I'm recommending this stock because of a dividend yield. A lot of the UK stocks are more dividend based than growth based, but especially the FTSE 100, but it has a 10% dividend yield, which is a very high dividend yield, and that is a payout rate of 63%, which seems to say that it's quite a safe dividend. So once again, I'm recommending Barclays because of it being a dividend play and it's a different industry, a well-known bank that people will probably carry on using going forward. I personally use Barclays a little bit as well, and I think they're quite well. I think they manage the company right well. So I like Barclays, and like I say, it's a bank play that I think is a very safe company and should carry on paying that dividend going forward. Number 3 is Barrett Developments, ticker symbol BDEV, which is a house builder, and also with this kind of play, it also builds commercial spaces, and it is 2 of house players on this list, but I generally do like house playing stocks really in the stock market, especially for the UK, because when I look at the UK, we're very short on houses. So these two companies that I see doing very well and have a little bit of decent growth and a little bit of a decent dividend in them. So I am a big fan of house builder stocks from the UK because, like I say, I think it's a safe industry right now. Sure, short term it might get hit by coronavirus, but there's still going to be a lot of demand out there for UK properties to get built because, like I say, we're so far behind what we need right now in the UK. I see both companies doing quite well. It's trading at £4.08 on Simply Wall Street. It says it's 70% undervalued. It has steady EPS and revenue growth, somewhere around about 2% a year. A fantastic balance sheet. It has cash 3 times to debt. I've got to say, I think on this list it's probably my favourite company actually on this list. It has a dividend yield of 11.42%, which is a very decent dividend, a fantastic dividend in fact. And get this, right, Barrett has a 39% payout rate of this dividend. So this is a very safe dividend with a fantastic balance sheet. So I really like this company. So with Barrett, I see it as a safe company that's really needed with the house builder industry, with the dividend as well, and it's very safe dividend, and you also get a slight little bit of growth in there as well. So Barrett Developments is definitely one of my favourite ones on this list. I'd probably have to put it in my top 3, with it potentially being my top favourite actually on this list. So Barrett Developments is I think a really good investment that's on this list right now. Number 4 is Dart Group, which is probably one of the most unknown stocks on this list, and it is ticker symbol DTG, and it actually isn't on the London Stock Exchange, it's on the smaller stock exchange. I've actually just forgot its name, but it's on the smaller London Stock Exchange. So Dart Group is a company that's actually based in Leeds, where I am from, and basically Dart Group own Jet2 Holidays, which is more of the well-known name that they actually own. It's a low-cost package holiday, so it's kind of like a Ryanair competitor, but a little bit more upper class than Ryanair. Basically, rather than just getting cheap flights, you get a package holiday which covers like your transfers, your hotel, your flights, your baggage, where you kind of don't get stung on any extras, and it's done fantastic. I actually use Jet2 Holidays and they are fantastic. I would only probably use Jet2 Holidays going forward because they're that good. They've expanded quite well, and like I say, obviously the coronavirus is going to hit them short term, but long term they've done so well. You know, a lot of companies that have struggled, like Thomas Cook, they've come in the place and took over them. They're trading at £5.37, which according to Simply Wall Street is 57% undervalued from where it should be. It has good EPS and revenue growth. It has a good balance sheet. It has cash 2 times to debt. Now this one's a little bit more of a growth play. It does pay a dividend, and dividend yield is 1.9%, which has a 10% payout rate, so that's an extremely low payout rate. But it is a small dividend, so it could probably, going forward, maybe up that dividend right now. But like I say, this is more of a growth play. Jet2 Holidays have been able to grow absolutely huge recently, and I see that going forward for them because they're a great company with a great product, a great service as well. So Dart Group, once again, I would say is probably one of my top 3 favourites on this list right here. I'd probably say it comes at the number 3 spot for me, but I really like this company. I know it really well, and I just see it carry on growing as holidays carry on going and flights carry on going, and the surge of bookings after the coronavirus. I see this company doing really well. Number 5 is Hollywood Bowl Group. Ticker symbol BOWL, Bowl, cool ticker symbol as always. And mainly Hollywood Bowl has been used to just being a 10-pin bowling place where you'd go to do bowling, but it has expanded now to arcades. It has bars in the venue as well, so they've kind of like wanted to get more of your money when you go there, which has been a fantastic improvement and has paid off for Hollywood Bowl. It's trading at £1.32, which is according to Simply Wall Street is 58% undervalued. It has good EPS and good revenue growth, so a little bit more of a growth company. It has an okay balance sheet. It just about covers cash to debt, which isn't too bad. A little nice dividend here though of 9% dividend yield, and it's 50% payout rate, which is pretty good. So with this company, you get a little bit of growth, you have that dividend as well. And like I say, I think as long as they carry on expanding, open a couple of venues every year, Hollywood Bowl should be carrying on able to, grow its EPS, its revenue, and carry on upping that dividend, which is a nice healthy dividend with this one. And obviously we've got 2 like leisure industry stocks here, but they cover different areas, and I like this play as well. So Hollywood Bowl is number 5. Number 6 is definitely the growth stock of this portfolio that I put down, and it's called BooHoo Group, and the ticker symbol is BOO, BWO. And basically, if you haven't heard of BooHoo Group, it's an online fashion retailer that's really starting to expand. It's currently valued at £1.90, which according to Simply Wall Street, it's 1.2 undervalued. But that's just because it's a growth stock. The price has gone up so much and analysts just can't keep up to date with upgrading the prices. Like I say, it has pulled back quite a bit when you actually look at the normal stock chart. It has massive EPS and massive revenue growth. It also has a fantastic balance sheet. It has limited debt on the balance sheet and a lot of cash there, so I really like that. It does not pay a dividend because it is more focused on growth rather than paying a dividend. But I do like this play. I think, you know, that's a new expanded space, is an online fashion industry, and as BooHoo carry on expanding, the growth will carry on going, and, you know, maybe down the line they'll pay a dividend because they could with the balance sheet, but at the moment, yeah, fantastic growth and fantastically well-run company, amazingly run company. So BooHoo Group is kind of like the growth company of this stock, this portfolio, should I say, sorry. And like I say, it's probably one of my favourite growth stocks that's out there in the UK. And number 7 is Redrow. RDW is the ticker symbol for Redrow. And like I say, it's another house builder, just like a Barrett. Don't build as many commercial spaces, but they are a massive house builder in the UK. And same again, I think, you know, as UK as a country, we need a lot more houses, so these guys should carry on doing well as we need to kind of carry on meeting that demand. Redrow is £3.31, which according to Simply Wall Street is 76% undervalued. It has good EPS and good revenue growth, just like Barrett, a good balance sheet, and also it pays a 9.23 dividend yield, which is a 35% payout rate, so that's a really good company once again with a balance sheet and its dividend yield, and it's been able to carry on paying that dividend going forward from here. So like I said, there's a little bit of growth in Redrow, but obviously you're probably going in for that big dividend, really a fantastic dividend with these kind of cheap prices that are going on. And like I say, it looks like it could carry on easily paying that dividend going forward. So you know, these two house builders on there, I probably prefer Barrett Developments over Redrow personally. But like I say, both really healthy companies with good balance sheets and good dividend yields to pick up. And that's me today covering 7 UK stocks to buy. As always, guys, I hope you enjoy the video. Any UK stocks that you like or you're buying, pop down in the comment section below because I'll check them out at some point. And like I say, I hope you enjoy the video. And like I say, if you get 50 likes, I'll make this a monthly series. If you get it to 70 likes, I'll run a mini portfolio on this and make a video about it as well. So there's a little bit of a challenge for you guys. And as always, hit that like button and I'll see you on the next video.